I'm glad to be here at the Cato Monetary Conference, a conference that over many years has made an important contribution to monetary policy thought. I'm glad to be moderated by Nick Timmeros, the voice of the Federal Reserve System, sometimes directly, sometimes indirectly, and to be joined by a group of distinguished panelists, particularly my old friend and teacher, former Governor of the Bank of England, Mervyn King. We come together at a contentful moment for monetary policy at the end of at the beginning of a period, perhaps, of significant inflation after a 40-year period of relative price stability. I'd like to make three observations broadly on monetary policy challenges going forward. First, on any theory that we have in economics, inflation at this moment was quite predictably an outcome of the policies that were being pursued. For those who, unlike me, believe in tracking money stocks closely, monetary growth accelerated very, very dramatically about a year and a half ago. For those who, like me, take a perspective that's more based on levels of aggregate demand relative to levels of supply, you had a combination of substantially negative real interest rates, a $2 trillion savings overhang from resources people were not able to spend during COVID, and massive fiscal expansion in the United States, totaling some 14% of GDP in 2021, against an output gap of perhaps 3% of GDP, that made a substantial overflow inevitable. True, there were bottlenecks. True, there were disturbances on the supply side. But many of those disturbances weren't really disturbances on the supply side. They were bottlenecks that arose from very strong aggregate demand. And the idea that there would be bottlenecks, that there would be constraints on supply in the aftermath of COVID should not have been surprising, especially given all that was said during the worst of the COVID period about business closures and subsequent reductions in the economy's potential. So for me, the inflation that has arisen was an entirely predictable consequence of excess demand. I don't think that inflation of 9% can be blamed entirely on excess demand. There surely have been supply factors, but it seems to me hard to escape the conclusion that just as during the Vietnam War, excess demand pushed America from being a sub 2% inflation country to being a 5 to 6% inflation country, that something similar has happened in the last several years. It may be that, as many have argued, that there is a fiscal theory of the price level aspect. I am open to considering these views, but at this point am somewhat skeptical because I believe that there is limited scope to monetize budget deficits in a world where money now pays interest in terms of deposits at the central bank, in a world where government debt has a relatively short maturity structure. In any event, I don't think the central problem was of some kind of conceptual understanding. I think the central problem was of a failure to act on the conceptual understandings that are well established in economics. You saw it in rhetoric that came out of the central banking community in late 2020 and early 2021, emphasizing their social responsibilities, emphasizing issues that monetary policy can't really address, like the particularly high unemployment rates facing minority groups or facing disadvantaged populations. I don't think there is an alternative response but to rely on restrained policies. My own reading of the evidence is that restraint applied more vigorously and more credibly is ultimately less costly in terms of unemployment, in terms of lost output, than restraint that is not credible. Just as nations that are better prepared for war are often less likely to have to fight war, central banks that are credible in their anti-inflation commitments will find fulfilling those commitments to be less costly. I welcome the evolution of the Fed's rhetoric over the last 6 months in this direction, most notably in Chair Powell's remarks in Jackson Hole, but continue to believe that it is very important to recognize that disinflation has costs and to signal a willingness to accept costs in order to achieve disinflation, rather than to undermine credibility by projecting serenity about the ability to achieve a soft landing. The grim truth is that soft landings are, in my view, what George Bernard Shaw said of second marriage, the triumph of hope over experience. My second observation goes to policy over the substantially longer run and references the period after the financial crisis in the United States. I am convinced that there is a broad range of forces that are operating to reduce neutral real interest rates. Some are on the savings side, increased uncertainty, increased life expectancy, an increased share of income going to those with very high incomes. Some are on the investment side, slower population growth, meaning less need for new tools to equip and house new workers, less need for new housing as fewer families form. Some go to the price of capital goods. A cell phone today has more computing power than a Cray supercomputer did in 1993, and yet it only costs $600. Investment banks, hotel offices, oil drillers tell me that one rig can account for twice as many wells as was the case 5 years ago. These examples could be proliferated. They all have in common an increase in the supply of capital relative to the demand. That means, to my mind, that neutral real interest rates are going to be substantially lower in the future than they have been in the past. Put differently, that means there will be a tendency for savings to flow into existing capital goods rather than new capital goods because of reduced investment opportunities. That means higher asset prices. That means more tendency to take on leverage. I regard these tendencies in the pre-COVID period as being driven by economic fundamentals rather than being driven by monetary policy error for the most part. Had monetary policy maintained rates, real rates at higher levels, I believe the likely consequence would have been even more sluggish growth and even more of a deflationary tendency than what we observed in the industrial world. I think there is a significant chance that as the extreme fiscal stimulus associated with COVID leaves the system, if inflation is brought down, that we will return to such a situation where the absorption of saving will be a crucial macroeconomic challenge. One of the great debates, it seems to me, will be whether that absorption of saving is best achieved through policy-determined very low real rates, possibly even negative real rates, or whether it is best pursued by fiscal and other structural policies directed at operating on the level of saving and the level of investment so as to raise the level of neutral real rates. My instincts, but I cannot prove that I am right, are on the latter side. I suspect that very low real interest rates court financial instability, make excess leverage and bubbles more likely, and also slow the process of creative destruction of failed or should be failed enterprises. And so if I am right, I think we will need to think about direct policies, whether it's changes in the level of deficit, redistributions from richer to poorer or from younger to older, measures to inhibit precautionary saving by providing better insurance, measures to directly stimulate investment in key areas like the environment where the social return exceeds the private return. These may be the better strategy for dealing with a savings absorption problem. But I think that reality is one we may well need to face again within a few years. My third observation is of a different sort. I have become increasingly convinced in recent years that central bank communication has lost its way. I believe that an earlier generation of central bankers, Alan Greenspan, particularly Paul Volcker, understood what the Delphi oracles understood, that if you are perceived as omnipotent and omniscient, it is a good idea to keep your statements vague and oracular so as to not destroy an illusion that gives people confidence going forward. The current habit in the central banking community of frequent forecasts, frequent press conferences, reliance on forward guidance seems to me to be quite problematic because inevitably forecasts turn out to be wrong, promises turn out to not be keepable, and the result is a substantial loss of credibility. The predictions made by the Fed in the spring of 2021 that interest rates would remain at zero well into 2024 seem to me to be a particularly extreme example of this phenomenon. The central difficulty with forward guidance, in my view, is that the markets don't believe it, so it doesn't have much of an impact on longer-term rates, and therefore not much of an impact on market behavior to stabilize the economy. On the other hand, central banks take their own forward guidance seriously and therefore are constrained to feel constrained to adhere to the policies they promised, even when those policies, in light of subsequent conditions, look unwise. After all, central forward guidance is without content if the central bank will do what is best moment by moment. It is only with content if it is constraining and influencing of policy going forward. And that can only be justified if it has substantial benefits at the moment that it is provided, something that at this point I regard as being unproven. So my hope, in sum, would be for central banking policies that are more humble in recognizing inherent uncertainties, less trying to precisely forecast or guide than has been the case in recent years, that there will be a clear recognition of the need for resoluteness even if there is a significant price around the containment of inflation, and that a great deal of thought will go into the era we may be headed into of secular low real interest rates, where savings absorption is a central problem.